Thank you for joining me for a look at sentiment and how sentiment affects the stock market. I'm going to look at a specific indicator and I'm going to look at a specific way to interpret it. Now, sentiment is an important indicator because it tells us how investors feel. And I know that's a discounted area to look at. Many of our modern investors believe that feelings don't matter. We should just dig into the price action. But consumer sentiment is one of the most accurate indicators of economic growth. And consumer sentiment is also a factor in the stock market. Sentiment surveys, which is a common way to measure sentiment, have a reliable track record. In particular, the American Association of Individual Investors does a weekly survey, in-depth data, great track record. Investors Intelligence tracks newsletter writers. Some methodology questions arise about that service. The track record there, much less reliable than what we see with AAII. This technique is also used by economists. Philadelphia branch of the Federal Reserve conducts a widely followed survey of professional forecasters. It shows us what they believe is the basic trend in GDP growth, inflation, and other important indicators. And again, we can use that sentiment to develop a reliable forecast. Now, often investors take a simple approach when they look at this data. They believe it's a contrary indicator, and a contrarian indicator says go against the crowd. There's an appealing logic to that. Bull markets basically end when we run out of buyers. And I know it's more complex than that. This is a very simplistic interpretation. Bear markets end when the sellers stop selling. And if you think back to 2009, we saw a huge decline and a V bottom. Basically, we had capitulation. Investors gave up, they stopped selling, the market rallied. So there's a real reason to look at the data this way according to the logic. But that assumes that sentiment is binary. It's actually possible to have three stages of sentiment: bullish, bearish, or neutral. And we need to remember, bulls buy, bears sell. Neutral investors build up cash. And because we have so much data from this AAII survey, we're able to test it and see what's going on. The survey is very simple. They ask individual investors whether they believe the market's going to go up, down, or no change over the next 6 months. Same question's been asked for 32 years, going back to 1987. And it's our detailed data set that we can slice and dice and find meaning in. Here's the most current results. What we see is the plurality leans to neutral. Number of bears, and then a smaller number of bulls. Now, we can take this, look at it based on history, and what we find is that as neutral reaches up towards about 40%, that's bullish. Remember, neutral means investors are building cash, and that's because many investors make automatic deposits into their retirement accounts, and cash builds up whether they put it to work or not. So when we see a high neutral reading, what we find is the S&P 500 delivers a much better than average gain. We have a higher probability of a gain, and that's the situation we're in right now. We also have $3 trillion built up in money market accounts, earning very little, if anything. Fed threatening to cut again, going to push some of that money market funds into the stock market. Sentiment's bullish. Look for readings in the AAII survey above 35 to 40% on the neutral side, and you'll spot high reliability buying areas. Thanks for joining me. If you found this information to be useful, please consider subscribing to my YouTube channel below. Thanks again.